Ever wondered how the stock market works? At its core, the stock market is a bustling marketplace where buyers and sellers trade ownership in companies. It's like a financial bazaar teeming with activity, where companies and investors come together to conduct their business. Companies issue stocks, which are essentially slices of ownership, to raise capital. When you buy these stocks, you become a partial owner or shareholder in the company. The stock market plays a pivotal role in facilitating this capital formation. But it's not just about buying and selling. The stock market also provides a platform for trading securities, offering a space for investors to juggle their investments. It provides liquidity, allowing investors to convert their investments into cash quickly and efficiently. The market is divided into primary and secondary sectors. In the primary market, companies issue new stocks to raise capital. The secondary market is where investors trade these existing stocks amongst themselves. So in essence, the stock market is a bustling marketplace where companies and investors interact. Now onto some fundamental concepts in the stock market. First up, stocks. These are essentially pieces of a company that you can buy. When you purchase stocks, you're essentially buying a tiny slice of ownership in a company. This makes you a shareholder, giving you a claim on a portion of the company's assets and earnings. Now, let's talk about market conditions. You'll often hear the terms bull and bear markets. A bull market is when everything's going great, stock prices are rising, people are optimistic about the economy, and there's a general sense of economic growth. On the other hand, a bear market is the exact opposite. This is when prices are falling, investors are pessimistic, and there's a sense of economic contraction. Remember, bulls charge ahead while bears hibernate. So a bull market charges forward while a bear market slows down and retreats. Finally, we come to market indices. Think of these like a snapshot of the stock market. They represent the overall performance of a group of stocks. Some of the most well-known indices include the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. These indices are used as benchmarks to gauge the health and performance of the market. So if you hear that the S&P 500 is up, it generally means the market is doing well. In summary, stocks represent ownership in a company, bull and bear markets denote the market's overall direction, and market indices provide a snapshot of the market's performance. Understanding these basic concepts is like learning the alphabet before you start writing sentences. They provide the foundation for further exploration into the fascinating world of the stock market. These basic concepts are the foundation for understanding the stock market's dynamics. Who are the main players in the stock market? Let's dive in and meet the key actors in this financial drama. First up, we have the investors. These are individuals or institutions who buy stocks with the intention of holding onto them for a longer period. They're looking for long-term growth or income. Their strategies may vary from value investing, where they look for undervalued stocks, to growth investing, where they seek out companies that are expected to grow at an above-average rate, to income investing, where they focus on stocks that pay regular dividends. Next, we have the traders. Unlike investors, traders engage in buying and selling stocks on a short-term basis, aiming to capitalize on market fluctuations. They come in different types. Day traders, for instance, make trades within a single trading day, while swing traders hold on to stocks for a few days or weeks. Position traders, on the other hand, may hold stocks for several months. Now let's talk about brokers. These are the intermediaries who facilitate the buying and selling transactions for investors and traders. They can be traditional brokers, who offer a range of services including advice, or online brokers, who provide a platform for self-directed trading. Online brokers have seen a surge in popularity due to their ease of access and lower fees. Lastly, we have market makers. These entities, which can be banks or brokerage firms, play a vital role in ensuring the smooth operation of the stock market. They provide liquidity by continuously buying and selling securities, essentially setting the market's pace by quoting the prices at which they're willing to buy or sell. So there you have it. Investors, traders, brokers, and market makers, each of these participants plays a unique and crucial role in the vast, complex ecosystem that is the stock market. They're the ones who keep the wheels of this financial machine turning day in and day out. These participants each play a crucial role in the functioning of the stock market. Next, we delve into the types of orders you can place in the stock market. Now, when you're ready to buy or sell stocks, you have a few options to choose from. Today, we'll focus on two of the most commonly used types: market orders and limit orders. Let's start with market orders. A market order is essentially a request to buy or sell a stock immediately at the best available current price. If you're looking to buy or sell a stock quickly, without worrying too much about the price, a market order is your go-to. It's straightforward, it's fast, but it comes with the risk of price fluctuations, especially in volatile markets. On the other hand, we have limit orders. Unlike market orders that execute immediately, limit orders allow you to specify the price at which you want your trade to be executed. For example, you might set a limit order to buy a stock at $10 or sell it at $20. This gives you control over the price of your trade, but there's no guarantee that the market will hit your specified price, and your order might not get filled. Now let's talk about stop orders and stop limit orders. A stop order, also known as a stop-loss order, turns into a market order once the stock reaches a specific price. It's a way to limit potential losses or lock in profits. However, since it turns into a market order, the price you get might not be the exact price you set. And finally, there's the stop limit order, which combines features of both stop orders and limit orders. It triggers at a certain price, but also sets a limit at which the stock should be bought or sold. This gives you more control over the price, but again, there's no guarantee that the order will get filled. Understanding these order types can help you execute trades more effectively. What influences the price of a stock? This is a question that often comes up when discussing the stock market. The answer is multifaceted, as a variety of factors can influence stock prices. Let's delve into some of these factors. Firstly, we have economic indicators. These are key statistics that signal the direction of an economy. They include aspects such as gross domestic product growth, unemployment rates, and inflation. Positive economic indicators often lead to investor optimism and rising stock prices, while negative indicators can result in investor pessimism and falling prices. Next, we have company performance. This includes earnings reports, revenue growth, and profit margins. If a company is performing well, it's likely that its stock price will increase. Conversely, if a company is underperforming, its stock price may decrease. Other aspects of company performance, such as changes in management, product launches, and competitive positioning, can also have a significant impact on stock prices. Market sentiment also plays a critical role. This is the overall attitude of investors toward a particular security or financial market. It's often driven by public perception, news, and social media. For example, positive news about a company can lead to increased investor confidence and a rise in the company's stock price. On the other hand, negative news can lead to a decrease in confidence and a drop in the stock price. Lastly, we have global events. These can range from political events such as elections or policy changes to global crises like pandemics or natural disasters. These events can cause significant shifts in investor confidence and lead to fluctuations in stock prices. So as you can see, stock prices are influenced by a myriad of factors. From macroeconomic indicators and company performance to market sentiment and global events, all these elements intertwine to dictate the direction of stock prices. These factors can cause stock prices to fluctuate, presenting opportunities and risks for investors. So there you have it, a beginner's guide to understanding the stock market. We've journeyed through the core functions of this financial marketplace, from facilitating capital formation for companies to providing a platform for investors to buy and sell securities. We've grasped the basic concepts like stocks, bull and bear markets, and market indices. We've met the key players, investors, traders, brokers, and market makers, each playing their unique role in the ecosystem. We've also learned about different types of orders like market and limit orders and how they help manage our trades. And finally, we've explored the various factors that influence stock prices, from economic indicators and company performance to market sentiment and global events. Remember, understanding the stock market is a journey, and every step you take brings you closer to becoming a savvy investor.